So this is the second Tutor Center for Finance 2, and my name is Fredrika, and today we will go through two or three questions based on, how far we make it. And I want to encourage you to ask questions if you have any, so you understand what's going on. So the first question we will go through is from Practice Exam 3, and the question is the number C. And in this question, no discounting is assumed. So $1 today is worth as much as $1 tomorrow. In addition, we know that the investors are risk neutral, which means that $1 today equals $2 or $0 tomorrow with equal probability. This is really important to grasp when you're doing these questions. Furthermore, we know that firms ABC operates for 1 year, and everyone knows that the cash flow of the firm will be $1,000 or $1,200 in the next years with equal probabilities. The firm has debt outstanding in form of a corporate bond with 1 year maturity and the face value of $900. So I will give you some time to write this information down. Yes. So the first question that we are supposed to answer is that we are supposed to calculate the value of the bond, the equity, and the total firm value at t equaling 0. And we will answer the question what the value is of the convertibility of the feature of the bond. Because we know that they have an outstanding debt, as I said before, of a face value of 900. But in addition, it's a convertible debt, which means that they can either receive $900 at T1 as it's their face value, or they can decide to receive 75% of the firm value at T1. So these are the characteristics of a convertible bond. That the debt holder have two choices at T equaling 1. Either first they can choose to receive the face value of the debt, or they can convert the bond into a percentage of the firm value most often. So the great thing about this convertible bond is that the debt holder doesn't have to decide whether he or she will convert the bond until they know what the outcome will be at T1. So that's really important to have with you during this question as well. So the first step in this question is to study the different possible outcomes for the firm at T1. So we know that at time 1, the firm value will either be 1,000 or 1,200 with equal probability of 50%. So here I decided to draw I think it's called 3 in order to see where the firm value will head at. And I would really encourage you to do these draw-ups in order to clearly see what the outcomes could be in each questions. Yes. So the first thing we know here is that the face value of the debt is 900. And we see that in each of these states at t equaling 1, either if the economy is good up here or if the economy is bad down here, we see that both of the firm values at T1 exceed the value of the face value of the debt, which is 900. So we know that debt holders in both of these outcomes will receive the full of 900, which is their face value. Yes, and now we need to know. Now we know that the debt holder will be able to receive the full 900 in each of the states. We need to take into account that they can also convert the bond into a percentage of the firm value, which is 75% of the firm value. So again, I draw a tree and add that the debt can be converted or not. So from before, we know that if it's not converted, we will receive a face value of 900, and we know that the firm value exceeds 900 in both of the states, so the debt holders receive the full 900 value. And we know that the debt can be converted into 75% of the firm value. And we calculate that as well. And we receive that the debt converted either will be 900 or 750. So by looking at this, we know that in the good state of the world, which is up here when the firm value is high, we know that the debt holders is indifferent of converting or not converting, since they will receive the same amount, 900, either way. And in the bad state of the world, when the firm value is 1,000, we know that the debt holders will prefer not to convert, since 900 is bigger than 750. Therefore, we can conclude that debt will never be converted, as you see here, with the green numbers. And the second part of this question was to calculate the equity and the amount of equity, the expected amount of equity. And we know that the equity holders will be left with whatever left of the firm value after the debt holder has received their part of the share. So in order to receive the equity that is left, we take the firm value minus the debt that is the debt holders will receive. So here, in the good state of the world, we receive 300 in equity, and in the bad state of the world, the equity holders are only left with 100. So the last step of the question is to calculate the present value of the firm, the debt, and the equity in today in T0. And it's important to know that in T0, so today, we don't know if the firm value will be high or low. So we have to take these probabilities into consideration when calculating it. And as I mentioned earlier, there is no discounting here, so we don't need to take any rates into account, etc. So the present value of the firm, then we take the probabilities times the firm value in each state and receive 1,100. For the present value of the debt, we take the probabilities times the value of the debt in each state of the world. And for the present value of equity, we do the same. The probabilities times what the equity will be worth in each state. Everyone following so far? Super. I will give you some time to just take notes. Okay, so for the second questions, we get some further information. The firm now has the opportunity to take on a new project called Tutor. The project doesn't cost anything today at t equaling 0, and the cash flow of the project are interdependent of the other cash flows of the firm. If undertaken, the project will pay off 500 or minus 600 in both states of the world with equal probabilities. So the question is, if we suppose that the debt isn't convertible, is it in the interest of the shareholders to undertake this new project? And is it in the interest of the debt holders that the project is undertaken? Furthermore, we are going to find out if the total firm value, if it's good for the total firm value if the project is undertaken. So again, The first we need to know that when is it of interest for the equity holders to take on the project. And as you know, equity holders as well as debt holders only care about the amount of money they receive. So the equity holders will take on the project if they receive a higher present value than the present value for them is without the project. And as we calculated before, the present value of the equity without the project is 200, present value for the debt holders is 900, and present value of the firm is 1,100. So now we will take this project into consideration and see if what the present value of the equity for the equity holders, debt holders, and the firm in total is, to see, to compare and see if this project should be undertaken. And what's important to know is that even though it's worse off, even if the debt holders or the total firm is worse off taking on the project, it is only the equity holders that decide if the project should be undertaken or not. So they will only care about their own, the size of their own present value. So again, we draw the 3 that is associated with the question. So again, I think this is the most tricky and the most important part of this question. Julia asked, what does it mean that the cash flows are interdependent? How do we take that into consideration? And that's actually exactly what we do here, because the what it means that the cash flows are interdependent is that the project's cash flow, either plus 500 or negative 600, doesn't have anything to do whether if the rest of the firm is bad or good. So as we calculated before, or as we saw before, the firm value could either be 1,200 or 1,000. And this is still the case for this question, but in addition, we have another project that could go bad, good or bad in addition. So that it's interdependent only means that the good or bad state for the project could happen in each of the scenarios, good or bad state for the firm. Does that make clear? Super. Yeah, so that's exactly what we've drawn here actually. So first we know that the firm can either go good and result in 1,200, or it can go bad and result in bad, in 1,000. And furthermore, we can take on this project that can go bad or good. And if it goes good, we have an additional 500 to take into account. And if it goes bad, it costs us $600 at T1. Yeah, so here's the outline for this question. And as I said before, I encourage you all to draw like a 3 like this when you get this question, because the questions will get trickier and trickier, I think. Yes. And furthermore, in this case, we know that the debt isn't convertible. So the debt will have a face value of $900 at T1. And what it means that the face value is 900 is that the debt holders will receive the total value of 900 if the firm value exceeds 900. And if the firm value is below 900, they will receive all of the firm value that is left. And the equity holders will be left with nothing. So we add on the debt column of this problem. And now we only have the debt that is non-convertible. So we see that in the first in the first outcome that can happen, the firm value exceeds 900, which means that the debt holders will receive their full $900. In the second state, it only is worth 600, which means that the debt holders cannot recover their full 900 amount, but gets all of it, the 600. In the third state, they will get 900 since the firm value exceeds 900, and the debt holders are left with a full $400 in this fourth state of the world. Super. And as we said before, the equity holders is left with whatever that is left when debt holders have received their part. So the only thing I do for this column over here is to take the firm value minus the debt value, or the debt holders cash flow. And then we receive that in the first and the third state of the world, when the project goes good, then the equity holders are left with 800 and 600. And now again, we calculate the present value of the firm, the debt, and the equity. And here, again, we take the probabilities times each of the states that the company is occurring in. And the 25% is received from multiplying 50% times 50%. So that's clear. And then when doing so, we receive that the present value of the firm today is 1,050. The present value of the debt is 700, and the present value of the equity is 350. And as you might remember from the last question, there the present value of the firm was 1,100. So we can see that the present value of the firm has actually decreased when taking on the project. The present value of the debt in the last question was 900. So the debt that has also decreased, while the present value of the equity was only 200 and has now gone up to 350. So the debt holders and the total value of the firm, that they are not so pleased, but the equity holders really like this project since their present value becomes higher and will therefore take on the project. I will give you some time to write this off now.
I was just wondering,
Yes.
in the present value of the debt, why is the second, let's say third term, is as 25% times 1,500?
Yeah, sorry, that's a typo for me.
Okay, okay, good. Because I was just like looking, I'm wondering where I could find it. Okay, perfect. Then I know.
It should be 900.
Okay, thank you.
Oh, sorry. Okay, now we move on to the third section of the question. And now the more information, the additional information that we receive is that the bond is now convertible and it could be converted into 80% of the firm equity at the end of the period. Again, we should now calculate the present value of the debt, the equity, and the total firm value if the project is undertaken. So again, as always, we start by drawing our possible scenarios for this question. Again, we have the firm and the project scenario, which we said before is interdependent. So we have 4 outcomes that can happen with equal probability. We know, as before, it's the same firm value, since that hasn't, anything regarding that hasn't changed. And the same for the debt that was non-convertible. We know that if the debt isn't converted, they have the same values as before. But the additional part of the question is that the debt can be chosen to be converted. And again, when the debt is converted, we take the conversion percentage that is mentioned as 80% times the firm value to receive the value of the debt when the when the debt is converted. Sorry. And as we know from before, the debt holders are only interested in receiving as much money as they want. And since they can convert the bond when the time one has come, they can choose to convert only when how do you say it? When it's good for them, when it results in more money. So we see that in the first state of the world, the debt holders are left with more when they convert. So that's what they will do. The debt holders is left with less when they convert in the second state, so they will choose not to convert. In the third state, it's better to convert. And in the fourth state, it's better to not convert it. So we remember this and make these numbers green. And when we have decided when the debt will be converted, we don't have to write out both of these columns, since we know that, in the first state of the world, they will always convert. So we will only take that part with us, if you understand. So here's we have the debt that is chosen: converted, not converted, converted, not converted. And again, we are asked to calculate the equity and what the equity holders think. And they are always left with what's left after the debt holder has taken their part. So we take the firm value minus the debt in order to receive the equity. And again, we are asked to calculate the present value of the debt, the present value of the equity, and the present value of the firm, which we do by taking the probabilities times the value of each, of the debt, equity, or firm value. And when doing so, we see that the present value of debt is 890, the present value of the equity is 160, and the present value of the firm is the same as before, since we haven't changed anything in this column. Yes. So if we compare it with the last question, the second question that we did, we see that the debt holders are much better off when the debt can be converted, since they received 700 with non-convertible debt and 890 now. We see that the equity holders are left worse off than with the non-convertible debt, since they don't receive the 350 anymore, and the present value of the firm is the same. So the last question is, will the project be undertaken when the debt is convertible? And we knew that the present value of the equity without the project from the question 1 was 200. We know that the present value of the equity when the project, with the project and with the convertible debt was 160. And we know that the equity holders only care about the size of their equity, and that it should be as large as possible. So they will always choose to not undertake the project, since the expected equity is larger than So here we see that the convertibility of the debt, even though, the convertibility of the debt adds value, since the value destroying project, Turdus, which resulted in a lower firm value than when the project wasn't undertaken, is avoided. And I will give you some time to write this off as well. Perfect. If we have no questions on debt convertibility or this like scenario outcomes question, then we'll move further. Super. So the second question is from practice exam 2, and it's the question D. And the question is about the change in capital structure for a firm. We are looking at a company named Stomp, which is an all-equity firm from the beginning. It has 20 million shares outstanding, and the price per stock is price per share is $7.5. Furthermore, they plan to announce that they will borrow $50 million in perpetual debt. The debt will be used in order to fund a repurchase of shares that are outstanding. Important to know is that the announcement to take on debt isn't anticipated by the shareholders, which means that the value change of doing so isn't incorporated in today's share price, which is then $7.5. And we know that after taking on this debt, there's no plan to increase or decrease the debt in the future. Furthermore, we know that the corporate tax is 40%. And the first question that we're supposed to answer is that what is the market value of the company today before the announcement? So always when you have a firm that will change the structure of capital throughout the question, I would recommend you to draw the company's balance sheet for every sub-question. Because by doing so, you're more likely to not get lost or to mix your results together, since the capital structure will change. So for the first question, we know that the company is an all-equity firm. And when we're drawing the balance sheet, we know then that it looks like the following. So we have assets only on the asset side, and we have only equity at the liability side. And the conclusion that we can draw from this is that the equity and the asset sides needs to be out of equal size. Yes. And the formula for the value of equity is the shares outstanding, like the number of shares outstanding, it should say, times the value of one share. So in our example, we have 20 million shares outstanding, and take that times the value of one share, which is 7.5. And we know, and we receive then that the value of the equity in the firm is $150 million. Furthermore, as I stated before, the value of the equity is equal to the value of the assets, since we don't have any debt in this company, as I draw up in the balance sheet before. And that means that the value of the assets also will be $150 million. And the question was to calculate the market value of the stock today before the announcement, and market value of the assets, which we have done now. So the second question is following. What is the market value of the company's assets right before the shares are repurchased, but after the debt is issued? So at this point of time, we know that the announcement, that the amount of shares are still 20 millions at the market, since the repurchase hasn't happened yet. But we know that the market value of the assets has been affected since we have brought on debt already. So again, we will begin by drawing the balance sheet. And we will now recognize that the balance sheet consists of more than just equity. So now we have equity and debt, and together they are of the equal size as the market value of the assets. So as the question says, we are interested in the market value of the assets of the company. Yeah, and as you have figured out, in order to reach the market value of the assets, we can take the market value of the equity and add that with the market value of the debt in order to receive the assets. And yes. So now we are interested in calculating the different parts of the equity and the debt. And we know that the debt, we don't have any debt from before, as I stated. So the debt will only be the new debt that is taken on, which is $50 million. And we know that the equity part in the balance sheet consists actually of two things. Firstly, the old equity that we calculated in the question before, question before. And then we actually have a new aspect of the equity when we brought along the debt. So as we talked about last time, debt financing does always have a positive effect on the market value of the company compared to when a company is taking on new equity. And this is due to the interest tax shield that is created due to the corporate tax, which is decreasing the cost of the actually paid interest costs. And that tax shield will show up as new equity in the balance sheet. So the present value of the tax shield is calculated taking the tax rate times the value of the new debt. And that results in 20 millions. So the value of the new assets are the components of the equity and debt added, which are 220 millions. So we can now note that an additional value of $20 million is occurring due to the financing through debt instead of equity. Everyone grasping that? Let's see. Super, thank you. Yes, so now we'll move on. The third question is, what's Stump's share price just before the share repurchase? And how many shares will Stump repurchase? Okay, so we know that the stock price is the market value of the equity divided by the amount of shares that are outstanding. And we know that the market value of the equity that we received in question 2 is 170 millions. And here again, we have the old equity value added with the tax shield that was created in the second question. So the new share price right before some shares is repurchased is $8.5. And this increase in share price is only due to the tax shield, the tax shield that is created and that is increasing the equity. Okay, so knowing that the shares now cost $8.5, we want to know how many shares that will be repurchased. And we know that they have $50 million that they have issued in debt in order to repurchase. And we know that each stock costs 8.5. So by this simple calculation, we know that they will repurchase 5.882 million stocks. Yes. So the fourth question is, what does Stump's market value balance sheet look like after the share repurchase, and calculate the Stump's share price after the share repurchase? So again, we begin by drawing the balance sheet, and now we add some numbers. So the old balance sheet before the share repurchase looked like the following. We had a debt of 170, the debt of equity of 170, the debt of 50. We had the assets old that we calculated in the first question of 150. We know that we received a present value of the tax shield of $20 million when taking on the debt. And we have the cash, which is the debt, the cash from when we took on the debt. So what is changing from this balance sheet to when we are buying the shares, actually? And what we know is that these $50 million in cash, these will be used in order to repurchase the shares that we want to. Let me just see. Yes, and we know that if we're taking a cash of 50 million from the asset side, something also needs to change in the liability side. And what we know is that we haven't repaid any debt, right? Since we're just repurchasing shares. So what will change is that actually $50 million of the equity will disappear in order to correspond to the change of cash. So the new balance sheet will look like this, where the cash of $50 million and $50 million of equity has disappeared. And we know again that we are supposed to calculate the share price that we have that is after the repurchase has occurred. And we know that the market value of the equity now is 120. We know that the number of shares are 14.118 millions after the repurchase. And therefore, we know that the new share price is $1.8. And as you remember, the answer of the second question, what the share price was right before the share repurchase, was $8.5 as well. And when we are receiving the same share price after, is an indication that we have done it correctly. Because if shares are repurchased, they shouldn't change in the share price. Super. Does anyone have any question? Super. Then I think we should vote, because I have one last question today. And we can vote if you want to take a break, or if we just want to go through the last question and then be done earlier. So raise your hand if you want to take a break. Super. Then we continue. And the last question is actually a rather short problem, but I think it's important to understand the different concepts throughout the question, since it contains a lot of information that is gone through in the course. So we will move on to the question B for the practice exam 1. And there we have a young company which requires financing today at T0 in order to produce any earnings at all in 4 years at T4. And we know that if no financing is obtained, the company won't exist in 4 years. So therefore it will produce nothing. And furthermore, we know that if the financing is received, the company would either produce earning of $21 million in 4 years, or they will produce nothing at all anyway. And we know that it's a 25 probability that they will produce earnings of $21 million. And we know that if they produce earning of $21 million, they will do it and have a PE ratio of 18. And a PE ratio stands for price through earnings ratio. And it can be used in order to value a company actually based on its earnings. So we know for the first question that the discount rate is corresponding to the riskiness of the venture, which is rather high, since it's only 25% probability that the company actually will produce any earnings at all. And knowing this rate, we should calculate the present value of the venture, which is today. So what do we know? We know that the company will either produce earnings of $21 million or 0. And if it does so, we want to know how much the company is worth. And as I said before, we have the price through earnings ratio, which we can use to do a multiple valuation, since we have the earnings. And we know that if we take the earnings times the price through earning ratio, we will have the value of the company. So in the first scenario, when the company produced earnings of $21 million, the value of the company will be 18 times 21, which is equaling 378. In the second scenario, we weren't even given a PE ratio, which is due to the fact that the value of the company is 0. So again, as the first question we went through today, we have 2 different possible states that the company could be in at time 4. So we will draw this 3 again. And we know that today we are here at T0. And we know that at T4, we will have 2 possible outcomes with the different probabilities stated here. And we know that the firm value is either this or this. So in order to calculate for the present value of the company, we take the probabilities times the value of the company and discount it to today's value. And it's actually pretty easy to forget to discount, especially since some questions doesn't include discounting. So I just want to remember that when going through the questions. So we take these 2 things into consideration, the discount rate of 33% and the probabilities for what the value will be in 4 years. So doing this and discounting it back, we will receive that the present value of the firm is $30.22 million today. And I will give you some time to write this up. Yes. So the second question is that given that the investment required is $7 million, what is the minimum fraction of the firm's equity that the investors will demand? So again, we begin by stating what we know. So we know that the present value of the firm is $30.22 million, and that is at, today, sorry. And we know that this project, in order to produce any earnings at all, requires an investment of $7 million today. So by that, we know that if the investor doesn't invest, the net present value is 0. And we know that if the investor invest, he wants to at least break even, which means that he should at least get his money back of 7. The expected value should at least be $7 million. So from an investor's perspective, the net present value of his investments needs to be at least 0. And the net present value is the investment added with the fraction of the company received times the present value of the company. And again, X is the fraction of the firm the investor needs to break even. So plugging these numbers into the equation, we know that the fraction of the company that the investor will demand is 23.18% of the firm. And by that said, we know that the firm actually needs the investor in order to produce any earnings at all. So this should be a clear decision, I think. Do you have any questions on this question? Yes, so this session today went a bit faster than the last one, since it took so much time. Last time I didn't have any other questions prepared, and since I was by myself this time as well. So if you have any questions about any other practice exam questions or any other concept questions that I can help with, I'm more than happy to help. So either write in the chat or stay a bit after the meeting. But otherwise, I say thank you for today and hope that we will see each other on Friday. Thank you.